The resurgence of U.S. China trade tensions has been a hot topic at the annual World Bank IMF meetings this week. CNBC's Karen Cho is leading our coverage of those meetings in Washington, D.C., and spoke to IMF's APAC director Krishna Srinivasan about how the global economy is navigating tariffs and trade.
So if you look at trade reconfiguration, that's been happening since 2016-17, when the initial U.S. China tariffs came into play. And so at that time, since then, what you see is that Chinese exports to the U.S. have come down, but China's exports to the ASEAN have gone up, and ASEAN to the U.S. has gone up. So there's been a reconfiguration. This is not rerouting. It's basically Chinese exports going to ASEAN countries. They're adding value there, and then they're being exported to the U.S. So that's been happening for some time.
So Chinese product is still getting into the United States.
Yes, and what we see different right now is with the trade deals being discussed, you have a lot more heterogeneity in tariff. So in terms of the reconfiguration, I think the current situation we are in right now with different tariff rates across ASEAN countries, across the rest of Asia, that could complicate reconfiguration going forward.
The U.S. Treasury Secretary Scott Bessent is now warning that China threatens to be seen as an unreliable partner by throttling more rare earths and critical minerals, saying the world will decouple from China if it continues to be an unreliable partner. Some see that as somewhat of a rich statement, given it's the U.S. that is perceived as the unreliable partner this year. But what do you make of the decoupling from China? Do you think it's got further room to run?
So again, I won't want to comment on what the Secretary said, but the point we're making is, in general, there are these downside risks to global growth. That could be because of trade tensions, and trade tension doesn't necessarily mean just tariff, tensions. It could mean, things like the rare earth, what we've seen there on chips and technology. All these things could have a significant bearing on the world economy. And to a point, if China slows, I mean, if we have shown numbers in the past that if China's growth slows down by 1 percentage point, rest of the emerging market world takes a 0.3 percentage points hit. So anything which happens in terms of trade tension between these two countries has a significant bearing on the rest of the world, including notably in Asia.
I want to ask you specifically about China. We're seeing significant AI innovation on the ground. It's been a very slow process to turn the economy around, but even recently some of the luxury numbers suggested that there may be luxury buying that is back. Is there any sense that there is a prop underneath the Chinese growth story?
So, we have China growing at 4.8% this year and at 4.2% next year. But our baseline is that over the medium term, China's growth would go to 3.5% because of rapid, aging and productivity declining. So anything which improves productivity in China, for that matter, will increase its growth prospects. So AI is one where it has potential for increasing productivity and growth. The question is, how do you pursue that? What are the governance frameworks that go with that? So in potential, yes, there is AI could generate growth upside risks for not just for China, but for any country. But that has to be managed well.